Thank you, everyone. Good afternoon. As Michelle said, I'm Ryan. We're going to be talking, hopefully, about all the kind of the variations from getting off the ground, getting your company off the ground, all the way to a successful exit today. My background is I was the CIO for a global fintech. When I started, it was probably a $25 million company, and we sold in 2020 for just over $2 billion. So now I play a lot of golf and just kind of hang out. I'm just kidding. I still suck at golf. Again, we are here to talk about, again, building with intention, thinking about valuation. How do you create additional value with your tech business? And then ultimately, how do you successfully exit? And I think we've got a great panel. We've got an investment banker in Mark, and they'll have a couple seconds to do an intro on themselves as well. In the middle, we have Grace, who is a senior tech exec at Cisco, Roblox, MongoDB, Atlassian. What's she doing in Philadelphia, right? But anyway, that's her story to tell. And then Patrick, who had a successful exit of his own. So we've got someone who can help with the exit, someone who was on the journey, and then someone from the buy side that thinks about what buyers are considering during that process. So again, valuation, right? With that said, I'll pause and I'll turn the floor over to Mark, and he can do a quick intro.
Just a quick one?
Under 5 minutes.
Just joking. Hey, everybody. Mark Gaeto. I'm with Falcon Capital Partners. Real quick on my background, I started out as a real lousy programmer, worked for big companies, like all of you, wanted to escape and start my own company. Did that and sold that right before the dot-com crash, luckily, whenever that was, probably before you guys were born or something like that. What I ended up doing was helping my peers figure out how to grow and exit. And I ended up at a place called Falcon Capital Partners, and we help people transact. We help them prepare and then go through the exit process and then think about life thereafter. And Patrick is one of my best former clients. So I'm looking forward to all your questions and having a great conversation today, and thank you so much for your attendance.
Grace?
Hello. Oh, wow. Now, usually people say, speak up, I can't hear you. So I am Grace Francisco. I'm originally from San Francisco. I was an executive at Cisco. I've been in tech for a really long time. Try to figure out that today. So yes, say hi to me later. So you're the Cisco person, right? Cisco, San Francisco. I've been in tech for a long time. My specialty craft is what's called developer relations or developer ecosystems. I've been doing that for a really long time. I was previously an engineer way back when at IBM. I had a couple patents that I earned at IBM before I even earned my degree because I was a working student. I worked nights and weekends. I worked during the day and did my college education nights and weekends. We didn't have online learning like you all have the opportunity to do. That didn't exist back in my day as a student. I have a perspective to share here on this panel where I am also an angel investor right now. I have just joined EMG. We're a venture studio. I'm creating a venture fund for them. I'm also an operating partner with them. So I'm pretty busy now with my new venture. And I have been an executive at very large scale companies where I've been on that other side thinking about and helping provide perspective to executives on whether we should do an acquisition or not. I can't name names of any companies, but I can at least share a perspective on how we looked at some of these things. And I'll turn this over here.
Hey, good afternoon. I'm Patrick Glennon. I'm a Philly kid, not Cisco, but right here in Philadelphia. So I actually started my career at the Philadelphia Inquirer and Daily News. And just saw how they operated and things they were doing, and I had ideas, like many of you probably had ideas, and I knew I could execute what I thought I could accomplish. So I left the Inquirer and I started with another group, and contributed to that group, and we sold that organization, but I still had ideas on how to change the way that publishing operated and change the way that media looked at audiences and such. So I went off and created Marketing G2 and exited that organization to Vista Equity Partners. And then they took my company and merged it with another company that had complementary type products and renamed it called Naviga Global. So I didn't get into this honestly to exit. And we'll come back to that. I just had this idea. It's like, I can't believe they're not doing this. Why aren't they doing this? But I learned a lot, and hopefully some of the things I did right, some of the things I did wrong will help you today.
Awesome. Thanks, guys. And that's a great segue, because I think, to your point, Patrick, even though, us as founders, we don't think about the exit, right, many times, but the sooner that you do, whether it's something you give to your children, the company you give to your children, or you IPO, or you are looking at an external exit, it's something that you want to plan for sooner rather than later. I know Mark and I have talked about this. I do some M&A consulting and kind of strategy, and I've had people come and say, hey, we want to exit next month. And that's just, it's not conceivable to do that, right? So in order to exit, you got to plan. So I think that's what we're going to come back to. But we want to talk about 3 different kind of sections today. So the first section is called Growth with Intention. And I'm going to ask kind of a kickoff question, and it'll be open, and then there'll be a couple of sub-questions kind of targeted after that, but feel free just to jump in. So the kickoff question is, when thinking about early growth, what are the most important things that founders should prioritize to build toward a future exit? What are the most important things that people should think about to prioritize toward a future exit?
So I'm going to interpret this broadly. Early growth, I work with a lot of very early stage startups, and first and foremost, you got to figure out your ICP and start creating your design partners or your early adopters for your product. And you need to think about how you're working in partnership, truly in design partnership with them, because those ultimately should be your case studies that then scale up what you're doing, because that's your proof and evidence that you have credibility, that you have something that is meaningful to those companies that are your early adopters. That is one of the key things that, as you are a founder who probably doesn't have a VP of sales yet in that early stage, you need to be doing what's called founder-led sales. You need to be willing to get out there, be uncomfortable with being uncomfortable in front of people, because that's probably a new thing to you. But if you are building it, it's not people are not going to come to you organically. You need to get out there and sell your baby, right? That is super important. Figure out who your ideal customer profile is. And once you get a handle of that, the repeatability of that is super, super important to your early investors, to your customers, right? Because it's all a cycle. You need to keep that wheel turning, right? And that flywheel motion going as fast as you can. So as you get that flywheel motion with your early adopters, hopefully you get what we called in Atlassian word of mouth. We talk about WOM all the time. You want those excited, happy early adopters spreading the word because they genuinely love your product. That's super important. So those early days, getting the product love, super important, and really working in partnership with those early customers and having that empathy, right? Really genuinely building with empathy, not just building your baby, but building the baby that other people are going to care about.
Mind if I add that? Sure. So so I was an engineer turned salesperson, and I
crossed over to the dark side,
right? What a lot of I think young entrepreneurs don't realize is that selling is a project. It's got phases, and it's got tasks, and it's got steps, and it's got deliverables. So you got to kind of set the plan and work the plan. So when you think about your ideal target, there's a bunch of other stuff that, how do I gain their attention? How do I create desire? How do I move them through the sales process and get them to a place where they're closing? And how do I make sure that it's all going to work for them? Because I have to show that what you're buying is actually going to have impact on your organization. There's going to be an economic impact. So you need to think about your business case. It can't just be this cool, sexy thing, look what it does. It needs to say, hey, I'm hitting your bottom line, and this is how it's going to do it. And so you need to have that economic justification plan in place so that you can leapfrog over all the other priorities and all the other things that a CIO or someone else, whoever your ideal buyer is looking at. Because trust me, Ryan can tell you, he was how many salespeople that you got,
ignore them every day.
Right. So you really got to find that punchy economic justification so their eyes tear up and they say, "What? So Mark's talking to me, right?" So I think, so set the plan, work the plan, make sure that you think about the economic justification.
I'd answer the question differently based on different times, I'm going to be honest. But if I look back and I think about, starting and you're building a business, you're working your ass off, you're selling, you're doing all these things. But what I wish I would have done, honestly, is reached out to people who were just much smarter than me about what does an exit even look like. Because I really wasn't thinking about it early on. And I should have. And here's the reason why. Even if you don't know what type of company you want to build for what type of exit, that's okay. What I wish I would have done, though, is built some muscle memory from the very beginning, okay? There's a lot that goes into building a business, but there's also a lot that goes into building a business that you can exit. And if you can start that business by just doing fundamental things and build some of those muscle memory in the way that you have an employee handbook. I mean, it sounds crazy, but there's a lot of little things that you should just do right from the beginning. So later on, when someone says, I want to exit in a month, you could. You could do it. But you won't be able to do it if you don't build some of that muscle memory early on. I've got other bits of advice, but that's the one thing I wish I would have reached out, like you are, to just people who've done this and understand it, because I could have done some other things. I mean, listen, the way you do accounting, you might as well do it right from the beginning, right? The way you organize your organization for sales, you might as well do it right from the beginning. So there are some things that you just want to make it as part of the way you do business and not be, oh, how do we set that up, Mark, now that we want to exit? Holy crap, I have to go back 5 years and redo this? So just build some of that right from the start. Don't let it block you.
Yeah, accounting is a strategic weapon. It's not a pain in the ass thing that you need to do to pay people and pay vendors and stuff like that. So you need to have an executive dashboard. And if you're a software company, for example, well, you're not a software company unless you're delivering 80% gross margins. So how do you do margin management? How do you figure out? And your biggest customer, by the way, may not be your best customer, although you may need them for a certain period of time for cash flow. Your biggest customer may be a 15% margin company. So they're sucking a lot of time for less cash flow than, say, someone smaller. So there's a whole bunch of things you can look at. We can get into that
Love
later.
it. Do it right, though. Yep. Think about it early and then set things up right? All right, so staying in that first section of growing with intention and really building the right foundation block. So Grace, this was questions for you, but Mark, Patrick, feel free to jump in. Grace, how should founders think about building valuation driving assets early on, especially when they're pre-revenue or just getting their first customers?
Okay, so the things that you really need to think about as you're building your company is what is it that's making your company special? Your customers, right? Your data. What's the novelty of your data, especially in a world of AI? Like really understanding the novelty of data you might have. And the other is like actively building your moat through things like APIs. Because if you have like a core product that people love, you want to build opportunities around that in your ecosystem so that your customers have optionality. So if you think about Atlassian had Jira, then they acquired Confluence, and then on both of those platforms we had extensibility. So when we think about extensibility, you're building your moat because with every add-on, every feature that a partner is adding, one, they're adding to the go-to-market motion because sometimes that key plugin or add-in is the thing that gets Jira or Confluence in their door, right? That niche solution. So super important. The other is the more options people actually install on the platform, it's much harder for them to leave so that sticky factor that you want. So you need to be thinking about that ahead of time. If you're going to publish an API, please, God, I'm just telling you because I'm an ex-developer. Do it the right way. Publish responsibly. Think of it as a public service. What I don't want you to do is to publish an API and do it quickly and then trash it. Like in a few months ago, oh, my version 2, I'm going to upend everything I did in version 1. That's irresponsible publishing. I want you to think about properly publishing your APIs such that your first set of services you're going to continue to maintain, and that the only reason why you're going to retire a service in your APIs is for a very, very good reason. Because guess what? Developers, they tend to be early adopters, and once you get them using that thing, do not horrify them by saying, I'm going to pull the plug on that after just a few months of work. Because they're spending a lot of time investing in you as the founder, your platform, as part of their business, right? So be respectful of your ecosystem partners, especially in those early days, because they are part of your success. I can't tell you enough how Atlassian's ecosystem was an enormous part of its tremendous success. And those people, those companies that bet on Atlassian really early on, they're the big successes on the platform still today because of those big bets. So just be mindful of things like that. I think it's super important. And then back to the data, there are a lot of AI companies out there right now. I think that I saw a stat with something like 80% of AI companies last year that were trying to get funding reported that they had unique and proprietary data, but only half of them could actually prove it. So do not say that you have unique, rich, proprietary data unless you can actually genuinely show it, because you will lose trust with your potential angels or VCs that you're trying to raise money with, and your customers and partners. So super important.
I'll just touch on something around product for a moment, because, I did a lot of great things. I also made some mistakes, and I was the owner and the guy driving product. And I will tell you, once I hired a real product manager, who's actually a VP of product, someone who really understood that you develop for purpose and not just develop but that's what they should be doing. So I'll just give you that bit of advice, right? Put some, I'll call it a North Star. Have some, rationale as to why you're doing certain things when you're in your product development life cycle. It's not hard to do, and you'll save yourself a lot of money. And if you've got an owner like me who's very passionate and wants to do, A and B and C, that process will say, you know what, you really should only do A. I lost a lot of money. Mark will tell you, I built some products that today, they're still ahead of the industry I was trying to sell them to. And they'll never get sold. They just won't. Because by the time they're ready, it's 3 years old and someone else has done it better, right? So, in the product development space, just, have some, approach that is, test it and you can just keep repeating it over and over again. Avoid the mistake I made of, you're smart, but that's not actually, the market's not ready for that, Or if you think they are, why don't you test something or put something out there in a way that validates what you think? So you're a startup. Use your money wisely. Put the right methodology in place around product. It's not hard. It really isn't.
There's a good book out there. It's an old book, but it's kind of like, the Bible of product development. It's written by a company called PRTN that I worked at for a couple years. The book is called PACE, Product and Cycle Time Excellence. And it was kind of written for the pharmaceutical and tech industry, software, hardware. And it was created for these, what they called high clock speed industries. People that, every new product meant a new revenue stream. So you think pharma, you think the next generation of some hardware component or disk drive or something like that. You think software. We did a project at Vertex Software. We did a project at SAP that I was involved in. So if you read it, it could be overkill, but it gives you some of the concepts, because they think the PRTMers thought very. They were structured thinkers, and they could provide kind of the phase, the task, the steps on how to innovate, create that business case, test the market, launch it, and then grow it, and then harvest. You sunset it even as well. So it's a good book out there.
Awesome, thanks guys. And maybe just to summarize, a point I heard in all three of your guys' statements was create the right process early as possible. And whether it's what you call a policy, a document, roadmap, Patrick, I think I heard you talk about a product roadmap, right? Do that early on. We all have ideas, and we all want to just run forth and create and then sell or do something, but you have to have the right order around that product, all right? All right, so we'll switch gears a little bit. We're going to get into some understanding and shaping valuation, and the big kind of kickoff question in this area is, from your experiences, what truly drives tech company valuations beyond the basic kind of financial metrics? Open question for anybody.
I mean, I'll just speak for what happened for my company, and Grace can probably talk about other types of companies, but for what I was doing, being like completely understanding that funnel, as I think one of Grace or Mark mentioned, you know, understanding the whole sales process of whatever you're selling from the top all the way down is really critical. But for my product in particular, being at the point in which someone's deciding to buy made the value really pop, okay? I had lots of really cool technology, and actually I thought some of the technology, it's still running 10 years later, because it was that unique in how it works. But what they valued more was the fact that we were right at that point in which someone was being influenced to buy or not to buy. So for our organization, that helped us, you know, we altered the way we designed some products to get closer, keep pushing ourselves at that point where we had the opportunity to influence purchase. And it helped, you know, our bottom line when we exited. I know there's lots of different ways to value companies, but for anything that's sort of touching the, you know, I was in a sales methodology is what I was trying to help them, you know, organize. Being at the very tip of that spear really helped us in the valuation.
I'll just simply comment on the fact that there's no black and white like methodology for evaluating a company. A lot of it is also driven by what's happening in the market at large. So, for example, with the tariffs that are going on right now, valuations are coming down significantly for startups. It's very difficult to fundraise, whether you are fundraising for your startup or you're fundraising for a venture fund. All of those things get impacted. Now, strangely enough, I was catching up with a friend of mine in Silicon Valley, my old home turf, and his remark was, I cannot believe these AI startups are so overvalued here. I am so over it. I'm just not doing angel investing right now because they are too overvalued. I said, well, that's really funny because we're in a capital desert here in the Philadelphia region, and we are almost overly pragmatic, and we're not valuing our startups as much as they should actually be valued in this area, something that I hold dear to heart and something that I'm very passionate about. I think we have so much tremendous potential here, but it's about the dynamics of where we are, right? I mean, when you read the news, there was I can't remember who recently got funded, but they got funded by their Chicago connection. Their co-founders out in Chicago. Let's hope that they stay here, but they weren't able to raise funding here. Now that just should not be the case. But again, it's not a black and white art. A lot of it has to do with like the specific region that you're in, your ability to pitch and really show value through your traction. Especially right now, you have to have some level of customer traction. It's extremely difficult to get funding unless you happen to be in Silicon Valley and you know some of the who's who in Silicon Valley, you're really networked in, and you can go just based on your PhD from Stanford. This still happens. I just heard about this morning. Still happens. But unless you're in that really niche group that's able to do that, you've got to prove value through your traction with customers and the market opportunity.
How many firms are true startups? What about later staged? Any late stage companies, any more mature companies here? I'm just trying to gauge my answer, that's why.
Anyone aspiring and being convinced not to do it
because,
now?
So look, so we're a bank. We're an SEC, FINRA regulated bank. We typically transact large companies, larger tech companies or healthcare companies is our focus. We don't really get involved in the startup world because, if I was representing one of your firms and I went to some venture firm, they would say, Mr. or Ms. CEO, founder, why do you have Gaeto involved? I'm going to give you $5 million, and he's going to take $500,000 that you could apply to your marketing budget. As a matter of fact, Bill Ackerman just made that comment yesterday on CNBC. So, So it's what Grace was saying is absolutely true. It's kind of timing, it's kind of location, it's kind of how sexy your application is. You all know it's all about the TAM, the total addressable market, how big that is, how quick you can penetrate it, et cetera. But as you mature, it's all about revenue growth, margin growth, and people, right? That's what a private equity firm would invest in. That's what a firm like New Spring or LOR would invest in. So if you guys track me down, I can give you a couple PowerPoints on how, what drives value in a technology company, or really any company for that matter.
One of the things that I'll just add, do you take investment or not if you're startups, right? And Mark, he sort of knows my history. I started the company. I didn't take investment, and I should have early on. I just didn't know any better. I was just naive. But as I got further into it, I thought, what I was selling was so new, and I had to actually educate people before they could buy it. It was like, let me educate them on why they need this, and then they'll buy it, right? So I really wasn't bought into the whole fact that I could have a true sales methodology. I was totally wrong, 100% wrong. The failure was I need to educate people so that they can go out and sell. I should have taken investment, and I should have put a real sales process in place. I would have grown so much faster, so much faster. Would I have given up some equity? Yeah, I would have given up some equity. But the math, I think, at the end would have turned out, better for me. And to be honest, my family would have been happier, because Mark will tell you, I was selling like crazy. Well, that means you're out on the road and you're distracting from other things. So there's opportunity loss that you need to think about, and it's not just money, it's not just the exit. The opportunity loss is, what are you doing with your time when you could take investment and use your time to do something that is actually better for growing the company, right? So sometimes early on as startups, step back and think of it that way. Think about, like, if you were freed up, how could you grow the company more? And how, what would that investment look like, maybe to free you up? In my case, I really should have brought in professional sales and sales methodology, and, it would have been frustrating, but it would have worked, and we would have grown faster in hindsight.
I just want to double down on this point because I was just talking with the startup exactly about this. We have a propensity, particularly in this area, our startups here tend to only want to keep it bootstrapped. They don't want to give away any equity in order to get that funding to scale. The problem with that is exactly what Patrick pointed out, which is you're not going to be able to scale fast enough, and someone's going to come in and eat your lunch. You need to balance that with what your opportunity is at that moment in time to scale and to go at speed. That's super important. So in the early days, if you haven't figured out your ICP and you're not doing founder-led sales, adding a VP of sales, big mistake. I read something about when you do that, it's like putting nitro behind a go-kart that has no wheels. You don't want to do that. Okay, so first and foremost, but you got your ICP, you're doing some sales, you don't want to be the founder going out on the road all the time when in fact you could have a sales motion and structure to that and be doing business development right at the same time so that you're capturing the right kinds of sales that you want to spend time on, doing that top-down motion. That is really an important thing to invest in, and you can't do that by yourself. You have to build a whole process and team around that, and you're going to miss an opportunity if you keep saying, I'm just going to stay bootstrapped. I don't want anyone else in this thing. And you do have to be careful about who you bring into this thing, but you're going to miss the boat if you don't think about that. So evaluating that on a quarterly basis, if not more frequently, is an important balance to strike.
Good stuff. All right, cool. Thanks, guys. All right.
We need to do a rapid fire.
Rapid fire. All right, we're moving along here. Let's jump since we have 10 minutes left. Thanks, Patrick. We're going to talk about preparing for exit. So the kickoff question for this is going to be, when is the right time for a founder to start planning? And what does smart preparation look like?
So we always tell people, we have a tagline at Falcon, your best exit plan is a growth plan. But how do you go about doing that? So you have to answer the question, where am I going? Which is your vision, should be 3 years out, not 5 years, not 10 years, 3 years out. It's got to be bounded by time, that vision, and that vision isn't some platitude. It's actually something achievable and demonstrable. So where are you going? How are you going to get there? What does that mean? That means, what are you going to fund? What initiatives are you going to fund? R&D, sales, capital expansion, et cetera. Could be HR. You should only have 3 initiatives. Otherwise, you're spread too thin. And then the third thing is, what's going to make you successful? And that's your competitive advantage. So you need to have that plan in place and growth plan and model it out. So when you talk about initiatives, that's got a budget, it's got a plan, it's got people, it's got metrics, it's got goals, right? You got to hold people accountable. And you as the CEO now can drive who's ever running those initiatives. Your sales team, your product development team, your finance and controller. So now you're stepping back and giving you the ability to scale, right? You got to be able to delegate. You got to learn how to do that. Setting the plan and working the plan and answering those 3 questions and putting them on paper, I think, is the best way to think about how to exit. Because if you're growing, investors are going to chase you down. Buyers are going to want to knock on your door and make an acquisition. So we always say your best exit plan is a growth plan, as long as you can execute it properly.
I mean, Mark, really, I thought he nailed it with that answer. And I would say build that muscle memory early on so it gets easier when you go to do the process, because the process can be a burden. We won't have a lot of time, but that's something you should be aware of. But the one thing I would say, and especially because I'm in Philly, is be fearless. Be absolutely, totally fearless. Because you've already made the decision that you're going to do this startup. You've already put all the energy in to think of the idea and to sell that idea to yourself. So you just be fearless, because there's no reason for you to fail other than you not trying. So just be fearless. And if your idea sucks, so what? Who cares? I mean, really, I have to tell you, Philly people are, in general, because I've been all over the world, we are fearless. And I would bet on any of your ideas, to be honest with you. I'm shocked to hear that this is a drought for money, because we really, we build organizations here that are filled with people like you who are, hey, I can make anything happen. And that's the attitude you need to take into this, right? Beyond the metrics, beyond, the muscle memory, just be fearless.
I think we should charter a plane of all the founders in Philly and head to Silicon Valley. Maybe we'll get funded.
Absolutely.
All right. One other question, staying in that same topic. By the way, if you have questions, don't forget about that URL top of that the screen there. So Grace, maybe you lead off with this one. What roles should ecosystem design, like the folks we're talking about now, advisors, early investors, consultants, et cetera, play in long-term growth?
So, as I mentioned earlier, choose wisely. Your angel investors, your advisors, right there. You want people who are willing to open up their network to you. So I've been invited as a strategic advisor and investor across a number of early stage developer tools companies. Why? Because I am one of the few global experts that's done this across enterprise, gaming, consumer, SMB, and fintech. I am the only person in my field that has done this across all those different domains. And so they want me on their cap table. They want me for credibility. My name is a brand to them, where they put me on their profile as part of the company investors, and it means something to other people. It's a credibility factor. And when I invest, I'm investing in the founder and their potential. And so I always offer, okay, how can I help you? When they send me. So the other thing is, some startups are better at this than others. You should always send your investors regular reporting and set that expectation. Is it quarterly? Is it monthly? But send it. Send it to them, because then in that communication, you can have that aha moment with your investors of, where you're at, where you need help, what you're trying to hire, right? All those things you should be leaning into your investors for help. Similarly, remember we talked about word of mouth, WOM, super important. You want to have those early adopters be your most excited advocates and like really continue to nurture and double down on those relationships of your most excited and committed partners and customers, because that can help with that flywheel motion, right? You want that organic piece, authentic piece of people referring back to you. And that really is a people to people, it's a relationship building thing at scale. So think about how do you do that at scale is super important for the ecosystem. And when you do that, you get network effects like at Roblox, being able to take a small 1 million number to 2 million the next year, to 4 million developers the next year. And that's all about investing, not just with every single developer. You have to have the right program, the right infrastructure, the right content. And if you get enough people who are excited about you in your community, helping out with other developers and partners, it can sort of help you scale up everything you're trying to do to evangelize and drive adoption for your platform or products.
So awesome. Thanks, Grace. And we have a couple of questions here. Did you guys have anything you wanted to add to that? Okay, cool. So I'm sorry, go ahead, Mark.
I was going to say, no, if you can have a set of advisors, whether it's a formal board or otherwise, early on that you can lean on, I think that's really good. Typically you can count on a number of different types of folks, attorneys, CPA firms. They'll give away pro bono help just because they want to nurture you long term, and in the event that you become the next Google or something like that. So don't be hesitant to create a small informal board of advisors.
Yeah, be fearless, as Patrick said. So just to build on something that Mark mentioned earlier and then Grace just talked about, the first question is, who are the salespeople that you did not ignore, right? And I think my answer for that when I was the CIO was someone that built their brand prior to them calling me. So Grace just mentioned that. And then earlier in the conversation, Mark talked about being able to add value without having to sell yourself, right? Sell your product. I hated the typical salesperson. I wanted to have someone that I knew, at least their company or them via a LinkedIn connection, and I saw them post, be that brand we just talked about. Be the brand. Own your product or your space or your product or your industry in that one little niche. So when you call me or email me, I know that person. I have that relationship, right? So that's the first one.
And I just want to add to that.
Sure.
The best salespeople, they're not just there saying, hey, I want to sell you something. They're really investing in the relationship such that when you actually need something, they call upon you as an advisor. You act as an advisor to them, right? You're giving them knowledge and support along the way for nothing, right? You're investing the time because you know that eventually at some point down the line, that person may need whatever your tool, your product or platform is. So it's an investment of time in the relationship so that it becomes like a consulting engagement at the end of the day.
The best salespeople ask questions. They're prepared before they go in. I mean, I ran sales for private and public companies. The thing that I was afraid of the most was you'd be driving in a car with your sales rep, your regional VP, and they're gaming it on the way over to the sales call. And the good reps had a sales plan, questions you're going to ask, background information on the people you're going to meet with, etc. So you prep and know how to ask questions. And then the other thing is you need to close for the most reasonable next step. You're seducing your buyer out there. There's a series of dates that you're going to go on and stuff like that. So you really need to be gentle and professional and fact-based. And Ryan's, you need to deliver value at each interaction that you have with a buyer.
I'll just add one thing real quick. If you're a startup and your product is very tech, heavy, get yourself a really good sales engineer. The best salesperson has a great sales engineer. Okay? So if you don't know what that is, circle back. We can fill you in.
Come find me later. I was a sales engineer a long time ago.
I can see it.
Love it. So we do have a few more minutes. We were just advised, so I have a couple more questions we're going to run through. Here's one open to the group. Given the need for customer feedback into the product development cycle as being at high, how early would you formalize the voice of the customer program? What would you base it on? Number of customers, et cetera?
Well, I think some of that has to do with what product you're selling too, because at least with my product, the voice of the customer was instant. If it didn't work, that phone was ringing instantly. So in some cases you're very close to your customer. So it depends on the product. But what I did in my organization was I hired someone who was really good at product management. And they built into the product management cycle customer involvement. So if you do the customer involvement when there's a problem, you're always reacting, right? You don't want to react. Get ahead of it. Have a product methodology that includes the customer. Don't let it be the other way around, would be my advice to you.
I mean, there's a lot of methodologies out there that you could use. Some of them might be overkill. We had something called the van program. We get a bunch of people, we jump in a van, and we go to Chicago, and we meet with 5 customers and have a set of questions that we've asked and come back and provide that to the development team. But we did it at a C level or a senior level. It's a cool little program. I probably have it buried in one of my fobs at home. But you got to get out there and talk. You got to get out there and ask questions. You got to do your competitive analysis. You got to do your SWOT analysis, and you can't just sit back in your ivy tower thinking you just created the greatest thing since sliced bread. So you got to slap yourself around a bit, and
Don't let the customers do that.
Yeah,
That's the point of counsel.
Yeah. Well, you got to do that too. you really got to test yourself. Anyway.
Okay, cool. One more question. I have a consumer-facing product. I've been told funding or exit for consumer is not of interest, only SaaS. Do I have to pivot? Or is there opportunity for funding or exits?
What do you mean by consumer product? Who asked that question? What is it? Is it like fragrance or food, or is it technology? Okay.
So those of us who do angel investing or doing venture funds, we specifically focus in areas that we're comfortable with. So we follow Warren Buffett's advice, invest in what you know. So I invest in developer tools. I invest in AI products that are B2B, right? 'Cause I understand the B2B model. So I think what you need to do is find angels and VCs that specifically focus on consumer tech that's AI enabled. And they are out there, but you have to go through a ginormous, the good news is there's a ginormous global list of these angel groups and venture funds, but you have to target specifically to those groups that are focused on those areas.
What's the feedback you're getting from consumers so far? Has it been positive? Did you test it out? Yeah. Well, then I wouldn't listen to the investors too much.
A lot of the investors
Yeah.
I don't think
Right.
Yeah. Not all investors are looking for the unicorns.
Yeah, I would.
It's wrong set.
One thing I'll add, this is an analogy. When you go to sell your house is only going to sell for what someone's willing to pay for it, right? When I went to go sell the business, people who were interested in my business, they told me how they wanted to look at my business, not how I wanted them to look at my business. If you get that opportunity to learn that early on, it will help you. I know for me personally, I did make some adjustments after getting feedback from people who wanted to buy my company. I adjusted the way I did contracts. I adjusted the way I did pricing to be much, much more subscription SaaS. It didn't change my business tremendously in terms of how we delivered products, but it certainly aligned with how people were looking at my business, right? The way I looked at it might have been different, but it didn't matter. They're the ones that were going to put the money up. So there is a little bit of, it doesn't hurt hearing the way they look at it. You may not like what they say, you may not agree, but there's no harm in looking at it that way.
Just a couple things on Grace's point. There are some local VCs, Ben Franklin Partners. Again, to her point, they all have kind of niches that they want to play in. In some cases, multiple niches, like Ben Franklin. There's a Cerity Partners, so we can talk after if you want a couple of contacts at some of those, okay? A couple more quick questions. I think we have a minute or two left. What are some examples of proven traction for a product? Proven traction for what data?
You said trashing. I can trash some products if you want.
Ask a customer, right? What data or proof are you looking for? I guess that it works, right?
I mean, for me, it was all contract based, but Mark can fill in more.
It's all about it's all about revenue generation. How many, what type of leads you have, what type of sales you're getting, what type of retention you have, that kind of stuff. So I'm probably not giving the answer you're looking for, but if you want to track me down after this, I'd like to understand the question better too. So traction's all around, money, right?
Yeah, that's a good point. We're up here after, so if you want to chat with us after or connect with any of us on LinkedIn, we'd be happy to dig through that.
One thing I'll add to that, when I was sitting in your shoes and I ran into other folks that were interested in my business, they were always strategic, right? Because they were hanging out the same places I was and they were meeting with the same people. So in my head, these strategics were putting shit in my head, but when you go to actually through the process, yeah, you'd love to have a strategic come and get as much money as you can out of them. But there's a lot more out there that have very structured ways at looking at, your organization. And whether you like it or not, they're going to want to put it into their structure. So it would help to meet with some folks and say, well, what am I? What do I want to be? What box do I want to fit in? Right?
One way to think about this, and it's something I mentioned earlier. So I sold a lot of enterprise-grade software, ERP systems, supply chain systems, procurement systems, things like that. And what we always did, how did we know we were going to have traction? Is when we did the economic analysis and we said, we're going to deliver $3.42 to your earnings per share. Bingo. That's the type of impact we're going to have because we're reducing cycle times. We're streamlining things. We're taking, we're making decisions easier. Lead to cash goes from 14 days to 14 seconds, that kind of stuff. So that type of economic traction, I think, is really important. When I used to talk to Jeff Westfall at Vertex, he, what we used to joke, what traction does he have? He goes, well, we keep people out of jail because they're going to pay their taxes properly. We would joke about that, but sales and use tax is something that, there was a compliance issue there. So you needed to comply. You were going to keep the IRS or any other governmental entity that was collecting taxes, out of your home, and you were going to comply, and it was great. So.
Just one point on fundraising. You don't have to go to VC or private equity if you're a little bigger. There are other options, obviously the bank, but then the bank you need 15 years of your financial performance and all that fun stuff. But there's non-bank lending options as well. I'm working with two firms now where that's probably their best bet. So if you have questions on non-bank lending, again, you don't give any equity away. It's just debt financing. So there's options there. I think we're kind of out of time and out of questions. So thank you all. Thanks for your time, guys.
Thanks, everybody.
Have a great day.